Why has the US crypto market structure bill ground to a halt just when both parties seemed ready to move forward? Galaxy Digital CEO Mike Novogratz cut through the noise in a recent viral post by @cryptosora_US. The real roadblock is UNT Washington politics, SCD the banking lobby. Stablecoins are reshaping how we think about deposits and yield, and traditional finance feels the ground shifting beneath them. Today we'll unpack Novogratz's analysis, the industry's response, and what this delay means for your portfolio as we head toward what could be crypto's defining regulatory moment. Let's start with the legislation itself. The market structure bill, sometimes called the Clarity Act in draft form, seeks to draw a clear line between SEC securities and CFTC commodities in the crypto world. Imagine trading Bitcoin futures without wondering which regulator might claim jurisdiction tomorrow. Both Senate Banking and Agriculture committees were scheduled for markup on January 14th, but the vote was suddenly postponed. Enter Mike Novogratz. Both parties want a bill, but banks make less on deposits moving to stablecoins. That's why it's stuck. The heart of the conflict lies with stablecoins, now exceeding $200 billion in total supply. Platforms like Coinbase offer USDC and USDT holders yields far superior to the 11 basis points banks pay on deposits. When the Genius Act passed last summer, it prohibited stablecoin issuers from paying interest, but allowed platforms to offer rewards programs. The new draft goes much further, effectively killing these yield products entirely. Coinbase CEO Brian Armstrong responded immediately. This draft favors incumbent banks at the expense of innovation. We'd lose entire product lines. His stance forced the markup delay as industry leaders regroup. You might wonder, how does a delayed Senate vote move markets? Bitcoin dipped about 1% immediately after the postponement, but the bigger picture reveals why this matters. Regulatory clarity doesn't just reduce uncertainty, it unlocks trillions in institutional capital. Think about Bitcoin ETFs exploding from $50 billion to over $150 billion in assets under management once spot approval came through. A comprehensive market structure bill would accelerate this pattern across derivatives, DeFi protocols, and custody solutions. President Trump's administration, now fully settled after January 2025 inauguration, has signaled strong crypto support, yet Congress holds the keys. The optimal outcome: light-touch stablecoin regulation preserving platform yields while clarifying CFTC oversight for most digital assets. The worst case maintains Gensler's regulatory uncertainty, stifling innovation. As we close this look at the crypto bill's quiet drama, picture this: banks and innovators finding middle ground, much like past market cycles that tested us before rewarding patience. Mike Novogratz sees compromise not as perfection, but as the key to unlocking real growth, steady inflows, clearer rules, and innovation that benefits us all. So, as negotiations unfold, what's your read? Will this bill pass by February and reshape our portfolios? Share your predictions in the comments. Let's discuss like fellow traders. If this resonated, hit subscribe for more thoughtful dives into these pivotal moments, and turn on notifications. Stay informed, trade wisely. Until next time.